Every investor, whether a beginner or a professional, faces one simple but powerful question. What is it really worth? You see, every stock, every property, every business has two values. The first is the price you see. The second is the worth you do not. Price is loud. It is visible. It changes every second on a screen. Value is quiet. It hides behind the numbers. It lives in the company's future, its people, and its purpose. In a world driven by speed and speculation, people often forget the difference between price and value. They chase what is rising. They fear what is falling. But true investors, the ones who build wealth slowly and wisely, look beyond the surface. They understand that valuation is not about guessing tomorrow's price. It is about discovering the truth today. Valuation matters because it gives you clarity. It helps you make decisions based on facts, not emotions. When others panic, you stay calm. When others rush in, you pause and think. That calmness comes from knowing what something is worth, not what others say it is worth. But here is the secret. Valuation is not only a science of numbers, it is also an art of judgment. It blends logic with intuition. It mixes hard data with human understanding. You cannot find true value by formulas alone. You must see the story that numbers are trying to tell. Every business has a story. It begins with an idea, grows with effort, faces challenges, and earns rewards. Numbers are just the footprints of that story. If you follow them with attention, they lead you to the truth. If you follow them blindly, they can lead you astray. In the chapters that follow, we will explore the main tools and ideas of valuation. We will see how investors use methods like discounted cash flow, valuation multiples, and qualitative analysis. We will understand why patience, discipline, and curiosity matter more than formulas. You will learn how to see beyond price tags and headlines and recognize value even when the world overlooks it. Before we dive into the tools and methods, we must first understand what value itself means. Because without knowing the meaning of value, all the methods in the world lose their strength. So let us begin our journey with a simple question. What is value? Chapter 1. The meaning of value. What is value? It sounds like a simple question, yet it is one of the hardest to answer. In the world of investing, many people confuse price with value. But price is just what you pay. Value is what you get. The two are not the same, and the gap between them is where opportunities hide. Think of value as the soul of an investment. It is invisible to the impatient eye, but clear to those who look deeper. A stock trading for $100 might be truly worth $50, or it might be worth $200. The market decides the price for the moment, but only careful thinking can reveal its true worth. Value does not change every second. It moves slowly, shaped by the performance and potential of the business itself. A great company might be ignored for a while, and a weak one might become the center of attention. But over time, truth always finds its way. Price and value eventually meet. The patient investor waits for that meeting. To understand value, you must see what drives it. At its core, value is created by the ability of a business to earn profits and grow them in the future. Every business is a machine that turns resources into money. The more efficient and durable that machine is, the higher its value. But value is not only about profit. It is about time and risk too. A dollar earned tomorrow is not the same as a dollar earned today. Future money has less power because of uncertainty. So when we calculate value, we adjust for both time and risk. This is the heart of modern valuation. Let us think of an example. Imagine a small bakery. Every morning it sells fresh bread to loyal customers. Its price on paper may be small, but its value depends on its reputation, the love of its customers, and its ability to keep earning year after year. Now imagine another bakery that sells fancy bread, but changes recipes every week and loses customers. It may look exciting now, but its value may be weak inside. That is why real investors always ask what the future looks like, not just what today's numbers show. Understanding value also means understanding people. Markets are made of humans, and humans often act on emotions. When fear takes over, they sell without thinking. When excitement grows, they buy without checking. This emotional behavior pushes prices away from value, and this is where the wise investor quietly finds opportunity. You see, value is not visible on a stock chart. It lives in the company's products, its brand, its leadership, and its purpose. A company that solves real problems for real people has lasting value. One that only follows trends may fade when the excitement is gone. When you focus on value, you stop reacting to noise. You stop worrying about daily price moves. You begin to think like an owner, not a trader. You start asking deeper questions. Is this business strong? Is it managed well? Can it survive hard times? Can it grow without losing quality? These questions shape your understanding of value more than any formula can. As you grow as an investor, you will realize that the search for value never ends. It is not a destination, but a way of thinking. It teaches you patience, logic, and calmness. And the better you understand what value means, the easier it becomes to ignore the distractions of price. Now that we understand what value is and why it matters, the next step is to explore the two main paths that lead us to it. One path is built on numbers and calculations. The other is built on understanding human behavior, business quality, and long-term potential. Both are vital, and both work together. Let us walk deeper into these two sides and learn how to see value from both the mind and the heart. The next chapter will take us there. Chapter 2. The two sides of valuation. Valuation has two main sides. One is built on numbers, logic, and data. The other is built on understanding, judgment, and experience. To find true value, an investor must learn to balance both. Think of it as the combination of science and art. The scientific side is quantitative. It looks at financial statements, profits, cash flows, assets, and liabilities. It uses ratios and formulas to measure the strength of a company. This side helps you stay grounded in facts. It gives you a structure, a method, and a sense of discipline. The artistic side is qualitative. It looks at things that cannot be measured easily. It asks questions like, who runs the company? Do customers trust the brand? Does the company have a long-term vision? Is it doing something that others cannot easily copy? This side gives you intuition, perspective, and understanding. If you rely only on numbers, you may miss the human side of business. You may think a company looks perfect on paper, but its management could be careless or dishonest. If you rely only on stories and emotions, you may fall in love with an idea and forget to check the facts. Both sides are important. They work like two eyes, helping you see clearly from both near and far. Let us take an example. Imagine two companies that make the same product. On paper, both earn the same profit. But one has a loyal customer base, while the other keeps losing clients. If you look only at numbers, they look equal. If you look at the story, you see that one business has a stronger foundation. That hidden strength is part of qualitative value. Many investors make the mistake of chasing quick profits without understanding what they own. They buy because prices rise and sell because they fall. But the real investor studies first. They read, they observe, and they ask questions. They use numbers to test their ideas, and they use judgment to understand what numbers cannot explain. The numbers tell you what happened. The story tells you why it happened. When you combine both, you begin to see patterns. You notice how great companies stay consistent in earnings. You notice how poor companies change direction every few months. This balance between logic and insight is what makes valuation powerful. Some of the best investors in history mastered this balance. Benjamin Graham, known as the father of value investing, focused on numbers and discipline. Warren Buffett, his student, learned to blend those numbers with business quality. Charlie Munger added the wisdom of psychology and human behavior. Together, they showed the world that investing is not about being clever, but about being wise. Numbers change quickly, but quality lasts longer. When you find a company that combines both strong numbers and strong values, you have found something special. That is where true wealth is created. Such companies not only earn money, but also build trust and resilience over time. Understanding the two sides of valuation helps you think more clearly. You stop chasing market rumors and start thinking independently. You learn to question every assumption and avoid shortcuts. You begin to see investing not as a gamble, but as a process of understanding value. Now that we have explored both sides of valuation, it is time to add a new layer to our understanding. Value is not only shaped by quality and profits, but also by time. $1 today and $1 tomorrow do not carry the same power. To understand this difference, we must explore one of the most important ideas in finance. In the next chapter, we will discover the time value of money. It will show how time shapes value and why the future must always be brought into the present when we calculate worth. Chapter 3. The time value of money. Time is one of the most powerful forces in investing. It can build great wealth or quietly destroy it. To understand valuation deeply, we must first understand how time changes the value of money. The idea is simple. $1 today is worth more than $1 tomorrow. Why? Because the dollar you have today can be used to earn more. You can invest it, lend it, or put it to work in a business. Over time, it grows. That growth is what gives time its value. If someone offers you a choice between $100 now or $100 next year, you should take it now. Because if you take it today and invest wisely, it can become more by next year. This simple idea is the foundation of every financial decision in the world. When we value a company or any investment, we think about the money it will earn in the future. But that future money is not as valuable as cash in hand today. So, to find out what that future income is truly worth, we must bring it back to today's value. This process is called discounting. Think of it like this. If a business will earn $100,000 5 years from now, that money is less valuable today because of time and uncertainty. We must reduce or discount it using a rate that reflects the risk and opportunity cost. The result is the present value. When we add all those present values together, we find what the whole business is worth today. This concept is not only about numbers, it is about patience, opportunity, and decision-making. Time can make good investments great, but it can also make bad ones worse. That is why understanding the time value of money teaches you to respect both growth and risk. Let us take a simple example. Imagine you buy a small farm. You expect it will give you a steady income every year. Even though the profit may increase over time, you still calculate how much those future profits are worth right now. Because waiting has a cost. Inflation reduces buying power. Uncertainty brings risk. And time itself has value. The longer you wait to receive money, the less valuable it becomes. That is why investors prefer cash flows that come sooner rather than later. But sometimes, waiting can be wise if the returns grow faster than the cost of waiting. It is all about balance. This is why the best investors think long-term, but still calculate carefully. They are patient, but not careless. They know that time is a friend to good businesses and an enemy to bad ones. A strong company uses time to grow earnings, expand markets, and build trust. A weak company wastes time and loses value with every passing day. When you understand the time value of money, you begin to see why short-term thinking often leads to poor results. Many people want quick profits, but real wealth grows slowly. The compounding power of time rewards those who wait and punishes those who rush. This is also the reason why interest rates play such a big role in valuation. When rates are low, the future looks brighter because the cost of waiting is smaller. When rates are high, the future looks heavier because waiting becomes more expensive. Every change in interest rates affects the way we value assets. In the real world, every investor uses the time value of money, even if they do not realize it. When you save, spend, or invest, you are deciding between today and tomorrow. You are choosing how much you value time. Understanding this principle opens the door to one of the most important valuation tools in finance, the discounted cash flow method. It is built on the same idea that future cash flows must be brought back to the present. In the next chapter, we will explore this method step by step and see how it helps reveal the true worth of a business. Chapter 4. The discounted cash flow approach. The discounted cash flow approach, often called DCF, is one of the most powerful tools in valuation. It helps investors see what a business is truly worth by looking at its ability to generate cash in the future. Unlike market prices that move with emotion, DCF focuses on what really matters: future cash and time. At its heart, the DCF method is simple to understand. Every business earns money over time. We estimate how much money it will earn in the coming years. Then, we bring those future earnings back to today's value using a discount rate. This process gives us the present value of all expected cash flows. That total represents the intrinsic value of the business. To see it more clearly, imagine a small cafe that makes steady profits. You believe the cafe will earn a certain amount each year and grow a little every year. You also know that money earned in the future is worth less than money earned today. So, you discount those future profits back to the present. If the total present value of all those cash flows is higher than the price you pay to buy the cafe, it is a good investment. If it is lower, it may not be worth the risk. The beauty of DCF is that it focuses on cash, not accounting tricks. Earnings can be changed by creative accounting, but cash is real. A company that consistently generates healthy cash flow is strong at its core. That cash allows it to pay debts, expand, and reward investors. However, DCF is also sensitive to assumptions. Small changes in growth rate, discount rate, or future projections can make a big difference in the final value. That is why investors must be humble when using it. The goal is not to be exact, but to be roughly right. As Warren Buffett says, it is better to be approximately right than precisely wrong. When using DCF, one must choose a discount rate carefully. The discount rate reflects two things: the cost of waiting and the risk of uncertainty. A safe company with steady earnings can be discounted at a lower rate. A risky company with unpredictable profits needs a higher rate. The higher the risk, the greater the discount. DCF also teaches us patience. It reminds us that value is created over years, not days. When you focus on long-term cash flows, you stop caring about daily price moves. You start thinking like a business owner, not a trader. But DCF has its limits too. In fast-changing industries like technology, predicting future cash flows can be very difficult. In such cases, the DCF model becomes less reliable. That is why experienced investors often use DCF alongside other methods like multiples or comparative analysis to cross-check results. Still, DCF remains one of the most respected tools because it ties everything back to one truth: a business is worth the cash it can produce for its owners. It separates noise from logic and helps investors see through market emotions. Think of it this way: when you value something with DCF, you are saying, "I do not care what others think today. I care about what this will be worth in time." It is a quiet, rational way to invest, based on evidence and patience. As you practice this method, you will start seeing patterns. You will learn which assumptions are reasonable and which are wishful. You will learn to adjust your discount rate to match your confidence in the business. And you will learn that the true art of valuation lies not in perfection, but in discipline. Now that we have explored how DCF helps estimate true worth, it is time to look at a different way investors value businesses. One that is faster, simpler, and often used for comparison: the multiples approach. Chapter 6. The Role of Growth. Growth is one of the most powerful forces behind value. It gives life to a business and shapes how investors see its future. But not all growth is the same. Some growth builds long-term strength, while other growth creates short-term excitement that fades quickly. To understand valuation, we must learn to tell the difference. When a company grows, it usually means its profits, sales, or customers are increasing. At first glance, that sounds good. But smart investors look deeper. They ask, how is this growth happening? Is it built on real demand, strong products, and customer trust? Or is it fueled by debt, marketing hype, or unsustainable discounts? True growth adds value only when it creates more profit for every dollar invested. If a company must spend more than it earns just to keep growing, that growth destroys value. Many businesses fall into this trap. They chase bigger numbers every quarter without checking if those numbers actually improve long-term returns. Let us take an example. Imagine two companies. One grows its sales by expanding slowly and improving efficiency. The other grows fast by cutting prices and borrowing money. For a while, the second one looks more exciting. But over time, it struggles to stay profitable. The first one, though slower, becomes stronger and more stable. This shows that quality of growth matters far more than the speed of it. Sustainable growth is built on three things: profitability, reinvestment, and time. Profitability gives a company the cash it needs to grow. Reinvestment allows that cash to create even more earnings. And time turns small steps into large results through compounding. When these three work together, growth becomes a source of value. Many great investors prefer steady, predictable growth over explosive short-term gains. Warren Buffett often says that he loves companies that can grow consistently without needing too much new capital. This kind of business keeps producing returns year after year while using little extra money to do so. That is the mark of efficient growth. However, growth also comes with risk. The faster a company expands, the more mistakes it can make. New markets bring competition. New products bring uncertainty. And new debt can bring danger. So investors must always ask if the company's growth rate is safe and sustainable. There is another side of growth that numbers cannot fully capture: emotional growth. When a business grows too fast, even its leaders can lose focus. They may forget the core values that made them strong. History is full of companies that expanded beyond their strengths and paid the price later. Growth without direction is like a river without banks. It can overflow and destroy everything around it. That is why the best managers grow with discipline. They take measured steps, build strong teams, and think about long-term value rather than short-term praise. They know that good growth attracts attention, but great growth earns trust. And trust, once built, becomes a powerful form of value on its own. When investors study growth, they must also consider how it will affect future cash flows. High growth today might not mean high value if profits cannot be maintained. That is where valuation methods like discounted cash flow become useful, helping us see how growth translates into real worth. In the end, growth is not just about numbers rising on a chart. It is about progress that strengthens the foundation of a business. It must be earned, not forced. When you find a company that grows wisely, patiently, and profitably, you have found something rare. Because true growth is not about running faster. It is about moving forward in the right direction, one step at a time. And that direction often depends on something deeper than growth itself, the power that protects it. To understand what makes growth last, we must look at the idea of moats, the barriers that keep competitors away. Chapter 7. The Power of Moats. In the world of investing, not every great company stays great. The difference between a temporary success and a long-term winner often lies in one simple idea: the economic moat. This term, popularized by Warren Buffett, describes the unique advantage that protects a company from its competitors, just like a medieval moat protects a castle from invaders. Understanding moats is essential for any investor who wants to hold stocks for years, not just months. A moat gives a company durability. It allows profits to remain high, even as rivals try to take market share. When a business has a strong moat, it can raise prices, maintain loyal customers, and keep competitors struggling to catch up. Without one, even the most profitable business can lose its edge quickly in a competitive market. There are several kinds of moats. The first is the brand moat. Think of Coca-Cola, Apple, or Nike. These companies sell products that others could technically replicate, but the brand power built over decades gives them pricing strength and emotional loyalty that no rival can easily copy. Consumers don't just buy a drink, a phone, or shoes. They buy the feeling attached to those brands. The second is the cost advantage moat. Companies like Walmart or Amazon can sell goods cheaper than others because of their massive scale, superior logistics, and operational efficiency. When you can produce and deliver products at a lower cost, you can either sell cheaper or earn more profit. This moat is hard to beat because it takes years of infrastructure and experience to build. The third is the switching cost moat. This exists when customers find it too difficult or expensive to switch to a competitor. For example, Microsoft's software products are deeply integrated into businesses. Changing to a new system would require retraining employees and reconfiguring operations, a costly move. This creates a natural customer lock-in, protecting Microsoft's profits. Another kind is the network effect moat. Social media platforms like Facebook or payment systems like Visa become more valuable as more people use them. A new competitor might offer similar features, but without users, it can't compete. The network itself becomes the barrier. Lastly, there's the regulatory or patent moat. Some industries, like utilities or pharmaceuticals, benefit from government protection or exclusive patents. These legal barriers keep competition limited and ensure consistent profits for years. A company can have one or multiple moats. The strongest businesses combine several, reinforcing each other like layers of armor. The key for investors is to identify which moat a company has, and whether that moat is growing or shrinking. A shrinking moat is a warning sign, even if the company looks strong today. Buffett often said, "The most important thing to do after buying a great business is to make sure the moat around it gets wider every year." Investors should always ask, what protects this business? Can competitors replicate its advantage? Is technology or innovation threatening its position? A great moat allows compounding to work safely over time. It ensures that earnings keep growing, dividends keep flowing, and reinvestment continues without disruption. It's what turns good businesses into legends. The true art of valuation lies not just in numbers, but in judging the durability of a company's advantage. Moats give investors confidence that future cash flows will remain steady. Without them, even the most attractive valuation can crumble overnight. In the next chapter, we'll look deeper into how qualitative factors, like management, culture, and innovation, combine with moats to create truly valuable businesses that stand the test of time. Chapter 8. The Qualitative Edge. Valuation is often seen as a numbers game: revenues, profits, ratios, and models. But behind every great number is a story, and behind every story is a human factor. The truth is, the best investors don't just analyze balance sheets, they analyze business quality. This qualitative side of investing, understanding the people, culture, and vision that drive a company, is what separates good analysts from great ones. The qualitative edge is about looking beyond financial statements. It's about asking deeper questions. Who runs this company? Do they think long-term? How do they treat employees and customers? Do they innovate or imitate? These questions may not show up in a spreadsheet, but they directly shape a company's future value. Let's start with management quality. A great business with poor management can destroy value fast, while an average business with exceptional management can thrive. Warren Buffett often said he looks for managers who are both capable and honest. Capability ensures they make smart decisions. Honesty ensures they act in shareholders' interests. Investors should look for evidence of consistent execution, transparency, and long-term thinking. Next is corporate culture. The invisible force that shapes every decision. A culture focused on innovation, learning, and customer satisfaction can create a self-reinforcing cycle of growth. For example, companies like Google and Toyota thrive because of their culture of experimentation and continuous improvement. On the other hand, cultures driven by ego, greed, or bureaucracy tend to stagnate. You can see this through employee turnover, customer reviews, and even how management communicates in reports or interviews. Then there's innovation and adaptability. Markets evolve fast. Technology changes how we work, shop, and live. The companies that survive are those that adapt. Think of Netflix. It started by mailing DVDs, but evolved into a global streaming giant because leadership wasn't afraid to disrupt its own business. Innovation is not just about inventing new things. It's about anticipating change and moving before it's too late. Another element is customer loyalty. A company that consistently delights its customers has an edge that competitors can't easily copy. Loyal customers become free marketers, defending the brand and ensuring stable revenue even during downturns. Apple and Amazon have mastered this. Their customers return, not just because of price, but because of trust and experience. Don't forget, reputation and ethics. In the age of information, reputation is everything. A single scandal can erase years of progress. Ethical leadership builds trust, and trust builds long-term value. Buffett famously said, "It takes 20 years to build a reputation and 5 minutes to ruin it." Finally, vision and mission matter more than most investors realize. A clear, purpose-driven vision guides decisions and attracts the right people. When a company knows why it exists, it stays focused and resilient during tough times. The qualitative edge can't be measured precisely, but it can be observed. Read interviews, listen to earnings calls, visit stores or use products. See how management reacts to failure or success. Numbers show you what has happened. Qualitative insight shows you what will happen next. In the end, valuation without quality is like a castle without a foundation. A cheap stock of a bad company isn't a bargain. It's a trap. The qualitative edge helps you see beyond the numbers to find businesses that are built to last. In the next chapter, we'll explore how the market's mood and psychology, often irrational, create mispricings that give smart investors their best opportunities. Chapter 9. Market Sentiment and Mispricing. The stock market is not always a place of logic. It is often a reflection of human emotion, hope, fear, greed, and panic. While valuation gives us a method to find true worth, market sentiment decides the price we see on the screen. Understanding this difference is what allows a wise investor to spot mispricing, when the market's view of a company's value doesn't match its real worth. At its core, the market is a voting machine in the short term and a weighing machine in the long term. In the short term, people vote with emotion. They react to headlines, rumors, and trends. Prices swing not because of changes in the company's fundamentals, but because of changes in perception. Over the long run, however, the true value of a business shows itself. Strong companies eventually rise, and weak ones eventually fall. Mispricing happens when the crowd either loves or hates a stock too much. During times of euphoria, investors chase the next big thing. They buy without question, pushing prices far above intrinsic value. During times of fear, they sell everything, even solid businesses, at deep discounts. Both situations create opportunities for the patient and rational investor. One of the biggest drivers of sentiment is news. Financial media thrives on excitement. Good news spreads fast, bad news spreads faster. Every headline can spark a reaction. A great investor must learn to read beyond the noise. Ask yourself, does this news really change the long-term story of the company? Or is it just a short-term wave of emotion? Then there's our herd behavior. People feel safer when they move with the crowd. When everyone is buying, it feels wrong to sell. When everyone is selling, it feels dangerous to buy. Yet, history shows that the best opportunities often come when you act opposite to the crowd. Warren Buffett's advice captures it perfectly. Be fearful when others are greedy, and greedy when others are fearful. Another important aspect is market cycles. Every market moves through phases: optimism, excitement, greed, euphoria, denial, fear, panic, and despair. Understanding where you are in the cycle helps you interpret prices better. When everything feels easy and riskless, you're likely near the top. When fear dominates and nobody wants to invest, you're likely near the bottom. Behavioral finance teaches us that investors often overreact to recent events. They anchor to the latest price, assume trends will continue forever, and forget that the future rarely repeats the past. This creates plotwrights, temporary distortions, moments when price and value drift apart. These are the windows through which disciplined investors step in. But spotting mispricing is not just about buying cheap stocks. It's about understanding why they're cheap. Some companies are undervalued for good reasons: weak management, declining industries, or poor products. The art lies in separating temporary pessimism from permanent problems. A calm mind and long-term vision are your best tools here. Markets will always move in cycles, but human behavior rarely changes. Those who can remain rational amid chaos gain an advantage that no algorithm or chart can match. To master valuation, you must not only calculate numbers, but also read emotions. The numbers tell you what a company is worth. The sentiment tells you what people believe it's worth. The gap between the two, that is where opportunity lives. In the next chapter, we'll explore one of the most powerful ideas in investing, the margin of safety. It is the shield that protects investors from errors, emotion, and uncertainty, turning mispricing into profit with discipline and patience. Chapter 10. The margin of safety. Every investor makes mistakes. No matter how careful your analysis, the future is uncertain. That is why the most powerful principle in valuation is the margin of safety. It is your cushion against error, your protection against bad luck, and your greatest defense against the unpredictable nature of markets. The idea of a margin of safety comes from Benjamin Graham, the father of value investing. He taught that the best way to invest safely is not by predicting the future perfectly, but by preparing for it wisely. In simple terms, it means this: never pay full price for a stock, even if it looks good. Always leave a gap between what you think something is worth and what you pay for it. That gap is your margin of safety. Imagine you estimate that a company is worth $100 per share. Instead of buying it at $95, you might wait until it's $70 or $60. Why? Because your valuation might be wrong. Maybe your growth estimate is too high, or your profit forecast is too optimistic. The margin of safety gives you room to be wrong and still come out ahead. It turns uncertainty into opportunity. This principle applies to all types of investing, not just stocks. Whether it's real estate, bonds, or startups, you must always leave space for the unknown. The world is full of surprises: economic downturns, management changes, competition, and global crises. The margin of safety acts as your protection when things don't go as planned. The size of your margin depends on the risk of the business. If you are investing in a stable, predictable company like a utility or a consumer goods firm, you may accept a smaller margin. But if you are investing in a fast-changing tech company, you should demand a much wider one. The less predictable the business, the greater the safety you need. Think of it like building a bridge. If the bridge is designed to hold 10 tons, engineers will test it to support 15 or even 20 tons. They don't trust everything to go perfectly. Similarly, an investor should never rely on a single perfect forecast. The margin of safety is your structural strength. Many investors lose money because they forget this rule. They fall in love with a story, ignore the risks, and pay too much. When reality fails to match their dreams, the price collapses. On the other hand, those who buy with a cushion of safety may still suffer short-term pain, but they often emerge stronger. This principle also helps control emotion. When you demand a margin of safety, you force yourself to be patient. You wait for the right price instead of chasing excitement. You think like a business owner, not a gambler. This discipline turns fear into advantage because you're buying when others are selling. Warren Buffett summed it up best. The 3 most important words in investing are margin of safety. It is not about perfection. It's about preparation. Even the smartest investor can be wrong about value, but the margin of safety makes those mistakes survivable. It's also a reminder that valuation is not a single number. Intrinsic value is a range, not a point. Your goal is to buy when the market price sits comfortably below the lower end of that range. That way, even if your estimate is off, you're still on the safe side. The margin of safety is not about avoiding risk completely. It's about taking risk wisely. Every investment involves uncertainty, but smart investors manage it instead of ignoring it. In the end, the margin of safety is what separates speculation from true investing. It brings patience, discipline, and humility, qualities that outlast every market cycle. In the next chapter, we will look at another hidden force that affects valuation deeply: interest rates. They silently shape how we measure value, risk, and opportunity in every corner of the investing world. Chapter 11. The role of interest rates. Interest rates are like gravity in the world of investing. They may seem distant or technical, but they quietly influence everything, from stock prices to real estate values to the cost of borrowing money. Understanding them is essential for anyone who wants to master valuation. At the simplest level, an interest rate represents the cost of money. When you borrow, it's the price you pay. When you lend or save, it's the reward you earn. But for investors, interest rates do something more important. They shape the discount rate, the rate used to calculate what future cash flows are worth today. Think of it this way. A company may earn strong profits in the future, but those profits are not worth the same as cash in hand today. The higher the interest rate, the less future money is worth. This is because you could earn more by simply keeping your money in a safe investment like a government bond. So when rates rise, the present value of future earnings falls, and stock prices often drop. When rates are low, the opposite happens. Investors are willing to pay more for the same stream of future cash flows because there are fewer safe alternatives offering good returns. This is why growth stocks tend to perform well when interest rates stay low. Future earnings look more valuable in comparison. Interest rates also affect the cost of capital. Companies borrow money to expand, invest, or operate. When rates rise, borrowing becomes expensive. Profits shrink, and risky projects suddenly look unattractive. When rates fall, money flows easily. Expansion becomes cheaper, and valuations rise as optimism grows. Central banks, like the Federal Reserve, use interest rates as a powerful lever to control economic activity. When the economy slows, they cut rates to encourage borrowing and spending. When inflation rises, they increase rates to cool things down. These moves ripple through the financial system, influencing investor behavior across the globe. But there's another subtle effect. Interest rates shape investor psychology. When safe investments like bonds or savings accounts offer low returns, investors move into riskier assets such as stocks or real estate to seek better gains. When those safe returns rise again, they retreat. This constant push and pull between fear and greed creates cycles of overvaluation and undervaluation in markets. For a valuation-minded investor, it's important to ask, what interest rate environment am I in right now? Because a company valued during a low-rate period may look very different when rates rise. A discounted cash flow model built with a 5% discount rate gives one result, but at 8%, the valuation could fall dramatically. That's why smart investors always test their assumptions under different rate conditions. Interest rates also reveal how investors perceive risk. The difference between a government bond yield and a company's expected return is called the risk premium. The riskier the business, the higher this premium should be. Understanding this helps investors judge whether they are being adequately compensated for taking extra risk. However, it's important not to treat interest rates as crystal balls. They move with countless global factors: inflation, employment, growth, politics, and confidence. Predicting them is nearly impossible. Instead, a wise investor learns to adapt. When rates are low, remain cautious of overpaying for growth. When they rise, look for strong businesses that can handle higher costs. Interest rates remind us that valuation is never fixed. It moves with time, policy, and perception. True mastery comes from understanding how those forces shape opportunity. In the next chapter, we'll discuss another invisible trap that destroys even the best investors: overconfidence. It's not the market that often defeats us, but our own certainty that we can never be wrong. Chapter 12. The Dangers of Overconfidence. In investing, knowledge is power, but overconfidence can turn that power into danger. Many investors lose money not because they lack intelligence, but because they overestimate their understanding and underestimate uncertainty. Overconfidence is a silent enemy that hides behind success, waiting for the right moment to strike. At the heart of overconfidence is a simple illusion: the belief that we know more than we actually do. After a few good decisions or lucky wins, An investor begins to think they have a special skill or insight. They start ignoring risk, dismissing doubt, and trusting intuition more than evidence. What follows is often painful. Missed warnings, bad timing, and big losses. The market has a way of humbling everyone. Even the smartest investors have been wrong at times. The reason is simple. The world is complex. Countless factors affect business performance, consumer behavior, and global economics. No one can predict them all. The moment you start believing that you can, you stop learning. And that's when danger begins. Overconfidence shows up in many subtle ways. Some investors trade too often, believing they can time the market. Others hold on to losing stocks because they are sure their judgment will eventually be proven right. Some rely too heavily on one method, one model, or one opinion, forgetting that no single approach fits every situation. Another common trap is confirmation bias, the tendency to seek information that supports what we already believe and ignore what contradicts it. If you think a company is great, you'll pay more attention to positive news and overlook the warning signs. This selective thinking strengthens overconfidence and weakens objectivity. Humility is the cure. The best investors are not those who never make mistakes, but those who recognize and learn from them quickly. Warren Buffett often says that he tries to stay within his circle of competence, investing only in what he truly understands. This simple rule keeps overconfidence in check because it acknowledges limits. Another way to protect yourself is through process over prediction. Instead of trying to guess where the market will go, focus on building a consistent decision-making process. Study the fundamentals, use conservative assumptions, and review your reasoning honestly. When your process is sound, even a wrong outcome can teach you something valuable. Overconfidence also feeds on emotion. When everyone around you is making money, it's easy to believe you're missing out or falling behind. This feeling of urgency pushes you to take risks you wouldn't normally take. In those moments, remember, patience is not weakness, it's strength. True investing is not a race, it's a discipline. History is full of examples of overconfidence leading to disaster. The dot-com bubble, the housing crash, and countless speculative manias. In each case, investors convinced themselves that this time is different. But markets always return to reality. Those who forgot humility paid the price. To stay safe, practice intellectual honesty. Admit when you don't know. Revisit your assumptions often. Listen to opposing opinions. The market doesn't reward arrogance. It rewards adaptability. The willingness to change your mind when facts change is one of the greatest strengths an investor can have. Overconfidence blinds you to risk, but humility opens your eyes to opportunity. The investor who remains curious and cautious will outlast the one who believes they are invincible. In the next chapter, we will look at how to compare companies wisely. Learning to see beyond size, hype, or brand name, and discovering the real differences that separate value from illusion. Chapter 13. Comparing companies wisely. Every investor faces the challenge of comparing one company with another. It sounds simple. Look at profits, growth, and market share, and choose the better one. But real valuation requires deeper thinking. Not all companies can be compared directly, even if they appear similar on paper. The art of comparison lies in understanding what truly makes each business unique. The first rule of wise comparison is this: compare like with like. A bank cannot be compared to a software company, and a retail store cannot be measured by the same yardstick as a manufacturer. Each industry has its own patterns, risks, and opportunities. Even within the same sector, two companies may have completely different business models. One might focus on premium quality, the other on low cost. Knowing these differences prevents you from drawing wrong conclusions. Start with business model clarity. Ask, how does this company make money? What drives its revenue and profit margins? A company that sells subscriptions will have steadier income than one that relies on one-time sales. A company that produces physical goods faces different challenges than one offering digital services. Understanding the model helps you see which business is more sustainable in the long run. Next, study Wanbori, profitability and efficiency. Metrics like return on equity, operating margin, and cash conversion rate tell you how well a company uses its resources. But don't stop there. Ask why one company is more efficient than another. Is it because of scale, better technology, or smarter management? Numbers alone don't tell the full story. Context gives them meaning. Then comes growth quality. Many investors chase high growth rates without questioning their source. But growth built on heavy debt, temporary demand, or aggressive accounting is fragile. Sustainable growth comes from innovation, customer loyalty, and competitive advantage. When comparing companies, focus not just on how fast they grow, but how well they grow. Pay attention to balance sheet strength. Two businesses may have similar earnings, but one might be loaded with debt while the other is conservatively financed. The stronger balance sheet provides flexibility during hard times and safety for investors. Debt magnifies risk and reduces the margin of safety. Another key factor is management integrity. A company led by ethical and transparent leaders will always outperform one run by short-sighted opportunists. You can often sense the difference in how they communicate, set goals, and allocate capital. A manager who prioritizes long-term health over short-term profits creates enduring value. Don't forget the SEC's competitive position. A business with a strong moat, such as brand power, patents, or network effects, can sustain profits even when competition intensifies. When you compare companies, ask which one can defend its advantage longer. The best businesses don't just make money today, they build barriers that protect future earnings. Also, consider valuation context. Sometimes a slower growing company can be the better investment if its price is far below its true worth. Comparing companies without considering valuation is like comparing houses without checking their price tags. The goal is not to buy the best company, but to buy the best value. Lastly, avoid the trap of rush short-term comparison. Quarterly results may show temporary differences that hide the true picture. Look at performance over several years to see consistency. Long-term patterns reveal which companies are truly strong and which are simply lucky. Wise comparison is not about finding perfection. It's about identifying strengths, weaknesses, and context. The investor who compares with patience and understanding sees beyond numbers to the real drivers of value. In the next chapter, we'll explore how all these ideas come together in one powerful relationship. Chapter 14. Intrinsic value and market price. Every investor must understand the difference between intrinsic value and market price. It is one of the most fundamental ideas in investing, yet it is often misunderstood. Intrinsic value is what a business is truly worth. Market price is what people are currently willing to pay for it. The two are rarely the same. Intrinsic value is built on the company's real ability to generate cash in the future. It reflects the strength of its business model, the quality of its management, and the sustainability of its competitive edge. It is not visible on the screen or decided by daily trading. It must be estimated carefully through analysis and understanding. Market price, on the other hand, changes every second. It moves with news, rumors, and emotions. One day, investors are full of optimism. The next day, fear takes over. Prices rise and fall, but the true worth of a solid business changes much more slowly. This difference creates opportunity for those who stay calm and think long-term. Warren Buffett once explained it simply: price is what you pay, value is what you get. The art of valuation lies in finding moments when price is lower than value. Those are the chances to buy. When price goes far above value, it's time to sell or stay away. To estimate intrinsic value, investors often use methods like discounted cash flow or earnings multiples. But these models are not perfect. They are educated guesses based on future assumptions. That's why investors must always combine analysis with judgment. A good valuation is not a single number, but a thoughtful range that captures both optimism and caution. Market price reflects collective psychology. It shows what the crowd thinks the value is at that moment. If investors expect endless growth, prices soar. If they fear recession, prices drop. Yet, in the long run, intrinsic value acts like a magnet, pulling market prices toward it as reality unfolds. This process takes time. The market can stay irrational for months or even years. But eventually, performance wins over perception. That is why patience is such a powerful advantage. Those who buy quality businesses below intrinsic value and hold them through temporary storms usually succeed. Understanding this difference also prevents emotional investing. When you anchor your thinking to intrinsic value, you stop reacting to market noise. You don't panic when prices fall, because you know the true worth is still there. You don't chase rising prices because you recognize when excitement has gone too far. You think like an owner, not a trader. Sometimes, market price stays below intrinsic value for a long time. This happens because investors prefer excitement over stability. A slow-growing but reliable company might stay undervalued for years while attention chases trendy sectors. But eventually, quality shines through. The market rewards consistency when the noise fades. On the other side, some companies trade above their intrinsic value due to hype or unrealistic expectations. Those are dangerous places to invest. When the truth surfaces, prices can fall fast. Avoiding such traps is as important as finding bargains. The key lesson is balance. Intrinsic value keeps you grounded in logic, while market price reminds you of emotion. You need both to navigate wisely. The best investors use market volatility not as a threat, but as a gift. An opportunity to buy value when fear dominates and to sell when greed takes over. The relationship between price and value is like a dance. Sometimes close, sometimes far apart. But over time, they always meet. Your job is to be ready when they do. In the next chapter, we'll explore one of the hardest challenges in modern valuation: how to value intangibles. In today's world, brand, data, and innovation can be more valuable than factories or machines, and learning to measure them is the new frontier of investing. Chapter 15. Valuing the intangibles. In the past, companies were judged mainly by their physical assets: factories, machines, and buildings. Today, the real value of most businesses lies in things you cannot touch. These are called intangibles. Ideas, brands, software, patents, data, design, and reputation. Understanding how to value these invisible assets is one of the biggest challenges in modern investing. When you look at a company like Apple, Google, or Coca-Cola, their physical assets are only a small part of their worth. What really drives their success are their brand power, loyal customers, unique culture, and ability to innovate. These qualities don't appear clearly on a balance sheet, but they shape the company's future more than any factory ever could. So how do you value something you can't see or measure precisely? The answer lies in observation, reasoning, and understanding human behavior. Let's begin with brands. A strong brand builds trust. It gives customers confidence that they will get consistent quality every time. When a brand becomes part of people's lives, like Nike or Apple, it allows the company to charge higher prices and keep customers coming back. This brand strength can be measured through repeat sales, customer surveys, and global recognition. Next, we have intellectual property, which includes patents, copyrights, and trade secrets. These protect innovation and prevent competitors from copying it easily. A company with valuable patents, like a pharmaceutical firm with exclusive drug rights, can enjoy strong profits for years. The key is to study how long those rights will last and whether new inventions can replace them. Then there's data, the new oil of the digital age. Companies like Amazon and Google have built massive databases of user behavior, giving them insights that competitors can't match. This data allows them to personalize products, improve marketing, and predict future trends. The more unique and actionable the data, the greater its value. Another intangible is human capital, the talent and creativity of the people inside the company. A skilled, motivated team can adapt, innovate, and outperform competitors even with fewer resources. That's why great leaders focus on hiring, culture, and continuous learning. You can spot companies that value their people by how they treat employees and how long top talent stays. Reputation also plays a crucial role. Trust takes years to build and seconds to lose. A company known for integrity and reliability attracts loyal customers, partners, and investors. A single scandal, however, can erase billions in market value overnight. When analyzing intangibles, it helps to connect them to financial results. Does the brand allow for higher profit margins? Does data lead to faster growth? Does a strong culture reduce employee turnover and increase innovation? The link between intangible strength and measurable performance is where true insight lies. Traditional valuation models like DCF or multiples often underestimate intangibles because they rely on past numbers. But the real challenge, and opportunity, lies in predicting how these invisible forces will shape the future. In the modern world, intangibles are not just extras. They are the core of value. They are what make businesses resilient, unique, and hard to copy. As investors, we must learn to see beyond the visible, to sense the power of ideas, trust, and innovation. In the next chapter, we will explore how valuation adapts in a changing world, where technology, globalization, and human creativity constantly redefine what value truly means. Chapter 16. Valuation in a Changing World. The world of business is never still. Technology changes how people live, work, and invest. New industries rise while old ones fade. Global markets connect in ways that were once impossible. In such a fast-moving world, valuation is no longer about finding a single fixed number. It's about understanding how change affects the meaning of value itself. Traditional valuation models were built for stable times. They worked best when industries evolved slowly, and competition was predictable. Today, we live in a world driven by disruption. A small startup can challenge a global giant. A new technology can make old products useless overnight. This means investors must learn to value adaptability as much as assets or profits. Think about how digital transformation has reshaped entire industries. Retail moved online. Cars became computers on wheels. Entertainment turned into streaming. In each case, companies that adapted early created massive value, while those that resisted change disappeared. The lesson is clear. The ability to evolve is itself a form of capital. The same applies to globalization. A company's market is no longer limited to its home country. Supply chains, customers, and investors now span the world. This offers growth opportunities, but also adds new risks, currency changes, political shifts, and cultural differences. A smart valuation must include these global factors, because they can lift or destroy future earnings. Another major force shaping valuation today is technology. Artificial intelligence, automation, and renewable energy are rewriting the rules of business. Some industries will shrink, others will grow explosively. The investor's challenge is to separate temporary trends from lasting transformations. For example, electric vehicles may be the future of transport, but not every electric car company will survive. Valuation requires both imagination and discipline. Then there's sustainability. Investors now look beyond profits to ask whether a company treats the planet and people responsibly. Environmental and social factors, often called ESG, can influence value in powerful ways. A company with strong ethics, low pollution, and fair practices can attract loyal customers, skilled employees, and long-term investors. On the other hand, those that ignore these issues face backlash, regulation, and loss of trust. In this changing world, it's also important to understand information flow. News travels instantly. Market reactions are faster than ever. This creates more volatility, but also more opportunity. The investor who can stay calm amid constant noise will find chances others miss. The key to thriving in this environment is flexibility. Don't rely only on old formulas or rigid models. Combine traditional valuation tools with forward thinking. Blend numbers with insight. Be willing to question assumptions and update them as the world shifts. Remember, value is not fixed. It moves with innovation, perception, and time. A company that seems overvalued today might look cheap in 5 years if it reinvents itself successfully. Likewise, a stable-looking business can lose value fast if it fails to evolve. The art of modern valuation lies in balancing stability and change. You must respect timeless principles, cash flow, margin of safety, and quality, but also understand that the context of those principles keeps evolving. The investors who will succeed in the future are not those who can calculate the most detailed spreadsheet, but those who can think deeply about where the world is heading. In the next chapter, we'll turn to the wisdom of the great minds who shaped these ideas, the masters of valuation and investing, and see what lessons they left for us to follow in a world that never stops changing. Chapter 17. Learning from the Masters. Every generation of investors produces a few great minds who see the market differently. They turn simple principles into timeless wisdom. Learning from these masters of valuation is not about copying their methods exactly, but about understanding how they thought, how they balanced reason with intuition, logic with patience, and numbers with human behavior. The story begins with Benjamin Graham, often called the father of value investing. Graham taught that investing is most intelligent when it is most businesslike. He introduced the ideas of intrinsic value and the margin of safety. To him, the market was like a moody partner, sometimes euphoric, sometimes depressed, offering prices that often made no sense. The intelligent investor's job was to stay calm, calculate value carefully, and act only when the odds were clearly in their favor. His lessons formed the foundation of all valuation thinking. Then came Warren Buffett, Graham's most famous student. Buffett took Graham's ideas and added a focus on quality. Instead of buying any stock that looked cheap, Buffett preferred great businesses at fair prices. He looked for strong brands, honest management, and long-term moats. His philosophy combined mathematics with human judgment. He taught that patience is the investor's greatest advantage, that time, not timing, builds wealth. Another master, Charlie Munger, brought the power of mental models to investing. He believed that to value a business properly, you must understand how the world really works: psychology, economics, history, and even biology. He showed that human bias, emotion, and error are often the biggest causes of poor investment decisions. His principle, invert, always invert, reminds us to focus on avoiding stupidity before chasing brilliance. Philip Fisher added yet another dimension, the qualitative approach. He encouraged investors to study companies deeply, visit their offices, talk to customers, and understand their culture. He believed the greatest profits come from finding outstanding companies and holding them for years, not from jumping in and out of markets. His idea of scuttlebutt, gathering real-world insight, is still a powerful practice today. Then there is John Maynard Keynes, the economist who also became a successful investor. He learned from failure that markets are driven more by emotion than logic. He shifted from trading to long-term investing, focusing on a few great ideas instead of many small bets. His evolution shows how humility and learning shape great investors. We can also look to modern thinkers like Howard Marks, who emphasizes risk management and cycles. He reminds us that the key question is not how much can I make, but how much can I lose. His writings teach investors to recognize when markets are overly optimistic or fearful, and to act opposite to the crowd. Each of these masters approached valuation differently, but their lessons overlap in meaningful ways. They all believed in discipline, patience, and independent thinking. They all respected uncertainty and used valuation not as a crystal ball, but as a compass, a way to navigate markets with clarity. Learning from them is like building a mental library. Each idea becomes a tool you can use when facing uncertainty. You learn to think in probabilities, not certainties. You learn that price and value are not the same, that emotion is the enemy, and that knowledge compounds just like money does. The true power of their wisdom lies in applying it to your own style. Don't worship the masters, understand them. Use their principles as starting points, not as limits. The world changes, but timeless thinking